All right, guys, the 7 most undervalued growth stocks to buy in April in 2024. I know this is primarily a dividend payout channel, but there's 7 of the most undervalued growth stocks that you have to check these out. Stay tuned to find out. Deckers Outdoor, DEC. Deckers Outdoor goes by the ticker DECK. DEC is gaining market share in the athletic apparel industry, while heavyweights like Nike are growing at slower rates. Deckers Outdoors continues to run laps around the competition. That's another reason why they are undervalued and possibly a value pickup. The corporation has several brands under its umbrella, but the 2 largest ones are Hoka and UGG. Revenue and earnings growth both came in at a healthy rate in the third quarter of fiscal year 2024. Sales increased by 16% year over year, while profits jumped 40% year over year. The recently added member of the S&P 500 has been on an incredible run over the past 5 years. The stock is up by more than 500% during that stretch. Now that is very nice. Momentum has continued based on the stock's 34% year-to-date gain, and shares have doubled over the past year and have a 32 to PE ratio. Now, guys, that looks very nice to me. Deckers Outdoor continues to expand its profit margins while gaining market share. The latest quarter featured 25% net profit margin. So moving on to number 2. American Express, AXP. American Express, everybody's familiar with it. The credit card company is a top-notch fintech stock with an impressive dividend program. They do offer a dividend, but they're also growth potential. That's why they made this list. The firm recently announced a 17% dividend hike. The quarterly dividend now stands at 70 cents per share. American Express has doubled its dividend since 2018. We're going on a 6-year run of that. That's very nice. And looks poised to elevate its dividend for many years. The company aims to report a 10% year-over-year revenue growth and a EPS growth in the mid-teens each year beyond 2026. American Express fulfilled that goal in the fourth quarter with an 11% year-over-year increase in revenue. Net income jumped by 23% year-over-year in that quarter. The stock has more than doubled over the past 5 years and comes with a reasonable 20 PE ratio. The firm also has profit margins in the low double digits and is poised to raise its margins each year for several years. American Express offers reasonable value and a compelling dividend growth rate for long-term investors. The yield is currently 1.24%. This makes it one of the most undervalued growth stocks to buy in April. So what is next? Alphabet, GOOG or GOOGL. Alphabet. So that's on NASDAQ, it's GOOG. NASDAQ, it's or GOOGL, is arguably the most undervalued member of the Magnificent Seven. The advertising giant trades at a 29 PE ratio and has been expanding its profit margin thanks to cost cutting and top line growth. The corporation reported 13% year-over-year revenue growth in quarter 4 in 2023 as its advertising segment continues to rebound. The 13% growing rate is an acceleration from last year's 7% year-over-year growth rate. It also reported a $20.7 billion in net income, which is 52% higher than last year's profit. Google Cloud revenue continues to grow at a faster pace than the company's advertising network. Cloud revenue reached an astounding $9.2 billion, which was 25.6% higher than the same period last year. Google Cloud had a $186 million net loss in quarter 4 2022, but turned in $864 million worth of profits in quarter 4 2023. Alphabet stock is up by 49% over the past year. It also gained 158% over the past 5 years and recently claimed an all-time high. It's also one of the most undervalued growth stocks to buy in April. I know they're also looking in expanding into their AI Google search, obviously there's a lot of competition. Everybody says, oh, with the AI, Google is going to be gone. Competition is going to plummet, but I don't believe that. Google is going to definitely, they have the money, the power, the resources, the engineers to accelerate and maintain their growth. So moving on, JP Morgan, JPM. Most investors wouldn't consider big bank stocks as growth stocks. However, JP Morgan is an exception. The financial institution has outperformed the S&P 500 with a 53% gain over the past year. JP Morgan has also been up by 89% over the past 5 years and offers a 2.31% dividend yield. The corporation regularly posts high profit margins that hover around above 25%. The stock also has a 12 PE ratio, which offers a good margin of safety. JP Morgan reported $9.3 billion in net income in the fourth quarter in 2023. It's slightly down from last year, but still paved the way for a 26% profit margin. Net income would have been $12.1 billion if it weren't for losses related to the FDIC special assessment and discretionary securities losses. Revenue increased by 11% year over year. Any banking fears can create a good opportunity for JP Morgan. The company swooped in to acquire First Republic, as that bank was about to go under and it could follow suit with other banks. When banks shut down, customers tend to put their money into big banks like JP Morgan to ride the uncertainty. So Synopsys, SNPS, is a semiconductor company, and right now semiconductors, it seems like we can't get enough. That creates high performance silicon chips. You can find these chips in machine learning devices, self-driving cars, computers, appliances, and other resources. Pretty much anything electronic will have these chips. The company has been in business for more than 35 years and has an annual revenue in excess of $5 billion. This semiconductor firm trades at 44 forward PE ratio and has a $63 billion market cap. The stock is up by 47% over the past year and has soared by an astounding 389% over the past 5 years. Synopsys reported a strong first quarter to start fiscal 2024. Revenue increased by 21% year over year, while net income surged by 65% year over year. And I don't see that slowing down with all the demand. There's so much demand for these chips. The company's net profit margin reached 27% in the quarter. All in all, it's one of the most undervalued growth stocks to buy in April. Synopsys stands to benefit from artificial intelligence tailwinds. Another key catalyst is the company's upcoming acquisition of ANSYS. The acquisition will help Synopsys gain market share and sustain high revenue and earning growth rates. So, Caterpillar, CEAT. Not a lot of people talk about this company. It offers an essential service. The company produces construction equipment and has been around for almost 100 years. The corporation has stayed relevant and expanded through various economic cycles, including the Great Depression. Now, if that's not sustainability, I don't know what is. The stock trades at an 18 PE ratio and offers a 1.43% yield. Shares are up by 59% over the past year and have rallied by 160% over the past 5 years. Caterpillar has an impressive dividend yield, a dividend program, and recently hiked its quarterly payout from $1.20 per share to $1.30 per share. That's an 8.3% year-over-year increase. If that doesn't make you happy, I don't know what does. Caterpillar recently reported a 13% year-over-year increase in full year sales. The corporation also returned $7.5 billion to shareholders in 2023 via dividends and stock buyback. Record sales and adjusted profit per share indicate the stock can continue to gain momentum from current levels. The stock is rated as a moderate buy with the highest price target of $395 per share, indicating an 8% upside. So let's get to this one. Meta Platforms is another one on this list. They own Facebook and Instagram and a bunch of other companies is gushing with cash flow after prioritizing profits in 2023. Net income more than tripled in the fourth quarter of 2023 and prompted the company to issue its first dividend. Revenue growth came at an impressive 25% year over year. That's an acceleration from the company's 16% year over year revenue growth for all of 2023. The company has a robust advertising network that continues to attract new users and increase the engagement of existing users. The number of daily active users across Meta platform social media networks increased by 8% year over year. Monthly active users were up 6% year over year across all of its platforms. Businesses can use advanced targeting features to get in front of the right customers. This advantage makes it more difficult for companies to switch from Meta platform to another opportunity that can generate similar returns. Meta platforms trades at 33 PE ratio and offers a 40% or 0.40% dividend yield. It's also one of the most undervalued growth stocks to buy in April. Thank you for watching. Hit that subscribe button. Let me know in the comments, do you agree with those 7? Do you own those 7 stocks in your portfolio?